Welcome to the Rose Show podcast. Thank you, everyone, for joining us today. I am here with Daniel Lacalle, a top global economist, PhD, chief investment officer, and chief economist. For speaking with me today. So how have you been?
I've been very well. Thank you so much for inviting me again. It's a great pleasure to be here.
Thank you so much. So, as I said before, a lot has happened since our last meeting. So let's begin. Last time we met, you said that debt is like drinking. It was a great analogy. So with the recent turn of events, the banking crisis, are we now reaching that point of realizing it's too late and suffering the consequences?
Certainly, I believe so. I think that the banking crisis is always viewed by media and by commentators as a cause of problems, but it's usually just a symptom. Banks, obviously, being the most exposed sector to the real economy and to the financial economy at the same time, being very leveraged entities, they are always the first ones to show the symptoms of excess, no? So I think that the recent developments, particularly in the United States with Silicon Valley Bank and with Signature Bank, what they show is how dangerous it is to implement negative rates and to believe that that is not going to have any consequence. And obviously, when things start to burst, which is what we have seen, everybody starts blaming the bad risk management of Silicon Valley Bank or the bad risk management of Signature, which to a certain extent you can say, but ultimately the cause is that they were accumulating a massive amount of sovereign bonds, long-dated sovereign bonds, and people that are watching us would ask, why would they do that? No? And the answer is because it's the least risky asset that gave them a little bit of return. If you're getting negative yields on two-year bonds, on short-term bonds, on cash, etc., and you have rising deposits, a bank literally can only park its liquidity in long-term sovereign bonds. And hedging the risk of duration, which is something that they have been accused of not doing, was probably something that was too expensive and probably even impossible to do to a complete extent, to 100% extent, for a very simple reason. When you get almost negative returns on your loans, and you get almost negative returns on your investments in sovereign bonds, hedging the risk of duration basically leads you to massive losses anyhow. So it was basically a very, very difficult situation. I'm not saying that they could have done things in a different way, but certainly what they are is symptoms of the excess of negative rates, the excess of massive liquidity injections, and disguising risk through quantitative easing.
Absolutely. You've been saying this for quite some time. And exactly as you just said, I'm reading in the news that they're trying to say it was all mismanagement by the bank. And exactly as you said, it's that free money and those negative rates that led to where we are now. I love what you said in particular. Cheap money is always expensive. And you repeatedly make that statement. Massive liquidity injections coupled with negative rates. And negative rates have also destroyed risk perception. And that was an excellent point that you made as well. And I believe your fantastic book, Escape from the Central Bank Trap, talks about all this. So with all that in mind, please elaborate on those points.
Okay. Yeah, in Escape from the Central Bank Trap a few years ago, I warned that expansionary monetary policy was actually creating the stages of the next crisis. Um, when you manipulate interest rates well below what interest rate should be, which is the cost of risk. Interest rate is the cost of risk. And if the central bank lowers massively the Fed funds rate, what happens basically is that you're disguising risk when the rest of banks are using uh, uh, as basis that level of interest rates. What is basically happening is that we get loans at much lower rates. We take more debt because we think that we can afford it. We believe that the risk that we're taking is lower than the risk that we're actually taking. So it disguises risk. And this is an important thing. Lowering interest rates and implementing negative interest rates is called financial repression for a reason. Ken Rogoff and Carmen Reinhardt coined this uh, uh, this term, financial repression, because the objective is that the economy takes more risk, is to make citizens take their deposits out, invest more money, avoid sovereign bonds making them more expensive, etc. So ultimately, the way that it works is, it may help in a period in which there is panic. Okay, there is panic and there's a big crisis, and you lower interest rates, you free liquidity, and you let the economy get more credit through the banking mechanism. Transmission mechanism of monetary policy works like that, no? But when you prolong it and you continue with it, no matter what, when in times of growth, in periods in which there is absolutely no problem with unemployment at all-time lows, etc., it at first most citizens and investors are aware of the level of risk that they're taking. But once it's 3 years, 4 years, 5 years of negative real rates and liquidity injections, what ends up happening is that you get used to taking incremental amount of risk for for decreasing amounts of yield. So, for example, if we had this discussion 10 years ago, and I told you that the Austrian government issued a 100-year bond at 0.1% yield, you would say, what the hell are you talking about? It makes no sense, no? Yet it did, no? So the elements that create a bubble are exactly those. So, and it's dangerous when you create a bubble and everybody understands, for example, that the housing bubble was created by very low rates, lending massively to people that couldn't afford it, and elevating aggressively the prices of homes for no reason through massive leverage. Everybody understands that. Well, transfer that to sovereign bonds and you make the bubble of everything. Because if you make sovereign bonds very expensive by lowering artificially the rates and by massively purchasing bonds, even in periods of growth, sovereign bonds, what happens is that all other assets become expensive by comparison and by default. Equities at 20 times, 25 times PE look okay. Venture capital deals at 15, 20 times EBITDA look okay. Negative yielding bonds look okay. Cryptocurrencies look okay. Everything. That's how you create the everything bubble. The problem is when the real estate bubble bursts, there is other assets that may compensate in a portfolio the decline of the price of real estate. But when you have created a bubble in sovereign bonds, what happened in 2022 is that you have nowhere to escape. Bonds go down, equities go down, emerging market equities go down. Everything, as you probably saw in numerous charts of the dreadful returns of assets in 2022. And that obviously, the next step is, one, central banks publish massive losses, which is what happened in 2022. Number two, you start to see bankruptcies of the weakest or the most exposed financial entities.
Thank you so much for that. You touched upon quite a few good points. I just want to mention that last time we spoke, you did warn about the sovereign bonds. So I think you knew something was coming, and here we are now today. What you mentioned is just human nature. It's like a recency bias. We all just accept this debt and we continue with it, and then we just think of this as normal. So our risk perception changes, like you said. So this all becomes normal and we expect it. So with the QE that we've had, it was like a drug addiction we had to all this massive liquidity injection. Can we ever go back to normalcy from the ZIRP, the zero interest rate policy, without further breaking the system? Is that even possible?
I don't think so. The problem, actually, in my book, "An Escape from the Central Bank Trap," I say this, is that it's very easy to enter into quantitative easing. It's very difficult to get out of it, because it's very easy to say, oh, we're going to do something exceptional, and blur the lines of risk, and therefore create this perception of wealth through asset prices. But it's very difficult to come back, for a very simple reason, and very complex reason at the same time, is that by the time that you decide to normalize, the system is so used to easy money that it simply cannot afford even mildly higher interest rates. And we're seeing it right now. You see all over the place. You've tweeted about it numerous times. Now, all over the place, lots of people infuriated about the fact that interest rates are rising, and despite the elevated levels of inflation and the fact that interest rates remain below inflation. But it's because even people that had invested allegedly conservatively find themselves that they had taken a level of risk that they could not tolerate in a normalized environment. Therefore, normalization, the new narrative is that normalization is the problem, not the excess. And that, if you remember, from 2008, in Europe, Jean-Claude Trichet, the president of the European Central Bank, was attacked as the person that created the crisis because he increased rates. Trichet lowered interest rates from 5 to 1%, and then increased them from 1 to 1.5, and they blame the 1 to 1.5 increase on the crisis. So the new narrative is always that the problem is the rate hikes, not the excess prior. And I think that is why, going back to your question, it's virtually impossible, and we're seeing it right now.
Absolutely. Now, if we look at the markets, we see that they're pricing in pauses and even rate cuts this year, which I find very surprising. But I guess they assume that that the Fed will give in and start loosening again. But that only perpetuates the problem. Just like, as you said, that was the problem, since the free money, the negative rate yields, and that's what caused the problem, not the recent tightening. And like Albert Einstein said, we cannot solve our problems with the same level of thinking that created them. So we need to find new solutions. So I'm going to ask you, because I highly respect you, Daniel. What would you do?
Okay. It's a great question, because usually the narrative also leads us to believe that this is the only thing that can be done. Okay, this is repeated often in economics circles, etc. But it's not true. Central banks do have the tools to avoid this, and the first one is to be truly data dependent. Okay, and I had the pleasure a couple of times of speaking with John B. Taylor, who published the Taylor rule that is known all over, which basically would eliminate the perverse incentives of discretionary monetary policy, which is basically, okay, if you have inflation and employment as your principles, and inflation is at a certain level and employment has reached the target, then you should actually hike rates and decrease money supply. So it should be automatic. It should not be something that is discussed among Federal Reserve FOMC members, and for example, as we saw before the previous elections, that the Federal Reserve sort of hesitates to change monetary policy before elections, despite a red hot employment market, etc. So the first thing is to implement what they already have, which is a Taylor rule, and the second is more difficult, which is what I advocate, which is that central banks include an analysis of asset inflation in their policy. They look at CPI inflation, consumer good inflation. They look at employment. They look at growth, but they don't look at asset inflation. When you see the S&P 500 reach all-time highs and multiples expand massively, stocks that actually are not providing better earnings go through the roof, valuations of bonds go insane. We had, for example, almost negative real yields on high yield bonds, etc. So to include some form of analysis of asset inflation, to implement policies that reduce the quantity of money and reduce the cost of and increase the cost of money when the market becomes too leveraged, so looking at margin debt, too aggressively exposed to the cycle, multiple expansion goes through the roof. It's simply just trying to analyze the impact of monetary policy in asset prices. Right now, for me, it's like they're looking at the world with one eye closed. They're not seeing half of the picture. The other element that I think is very important is that, believe it or not, central banks have stopped paying attention to monetary aggregates. And this is something that is baffling, to be fairly honest. The fact that they see money supply growing twice, 3 times as fast as GDP grows, and they don't say anything or do anything. They're just okay. So to think that the employment created by massively increasing debt, or that the growth created through massive increases in debt and public spending is not going to come back to bite you a few years later is very dangerous. So they have the tools. They should pay attention to monetary aggregates. Money growth should not be higher than real GDP growth, and that's Friedman rule that they don't follow either. The Taylor rule is more ample, and they could look at it as well. But certainly they should. I mean, by now, I think it's almost incompetent or irresponsible not to include an analysis of asset price inflation in their policy, because it's driving to what is happening right now.
Absolutely. Thank you. Perfectly said. Also, I believe everyone's talking about interest rates, but few are focusing on the increase in money supply, which was the cause of the inflation. And I love when you make that point, how forget cost push inflation or demand pull, and let's look at it's just too much money chasing too few of goods and services, and that is the cause of inflation. So I love that you always bring up that point, and you really expose the realities of economics and what's really the truth behind everything that's going on right now. So thank you for all that. Daniel, do you think that they will proceed with what you proposed and look at those asset valuations and continue with their rate hikes and work on reducing the balance sheets necessary to bring down this inflation amidst this banking crisis without further breaking the system?
No, I don't think so. I don't think so. And I don't think so because I I thank you for saying that what I say is resonates with what you think as well. But there is an entire and very, very dangerous group of people who know that what I'm saying is also true, but will always defend the financial repression and the expansion of money at any cost, because it also expands the size of government. And that's so we must understand that this is not incompetence or lack of understanding of the impact of money and inflation, but it is. But there are people who probably have a certain level of goodwill because they believe that that is good, that think that massively increasing deficits and hugely bloated government is the solution to the economy, despite the evidence that it's the opposite. No, and you may have heard some alleged experts saying that deficits are actually reserves for the private economy, which is a stupid. It's baffling, to be fairly honest. It's completely shocking that this upside down economics is actually taking hold of monetary institutions. But it is. But it is. And you hear all types of excuses. So the Federal Reserve remains relatively orthodox, relatively, okay? So they're actually paying more attention to the things that matter than we probably give them credit for. But certainly, the European Central Bank, the Bank of Japan, are nowhere close to being orthodox and realistic about money and its impact on boom and bust cycles. No?
Thank you so much. I agree. It's not a matter of incompetence on their part as well. Let's go into banking. We've been talking about it, and that's exactly what has transpired since we last met. Now, like you mentioned, there were unrealized losses from negative yielding bonds, duration risk, Silicon Valley. Then we have Credit Suisse, and now they're talking about Deutsche Bank. I know the European banking system is worse than the US. And I heard you speak about that on one of your meetings as well. I'd like to first, before we go into all that, do you think there's a potential for, in the future, potential debasement of fiat currency based on all that's occurring and may continue? And could this be building a case for Bitcoin?
It's a good point. We are living the debasement of fiat currency, no? Although the dollar is strong relative to the rest of fiat currencies, or most of the rest of fiat currencies, the dollar is losing purchasing power for all citizens of America by inflation, no? And inflation is the destruction of the purchasing power of a currency. So the dollar is weakening. The dollar it has a lower purchasing power for all Americans, but also the rest of currencies are also losing purchasing power. So basically, disposable income and the wealth of salaries, the purchasing power of salaries and savings in deposits is being eroded clearly. Does it create a platform for Bitcoin? I think that Bitcoin is proving to be some possible alternative, and it's doing two things. It's starting to show that it can be a reserve of value, a unit of measure, and a mean of payment of generalized use, which is what creates money, which is what it would be called money. But what's more interesting is that Bitcoin is separating itself from all other cryptocurrencies. I think that is the most important part, actually. That instead of being part of an asset class that fluctuates with different, I would say, trading or exposition to the cycle metrics, it is starting to separate itself from other cryptocurrencies. So that is interesting. However, it is still not an alternative to fiat currencies. Not at all. Not at all. But it may. My opinion is that it may be the case that Bitcoin and other cryptocurrencies, if they evolve and grow to be viewed as proper money, will coexist with fiat currencies in a different universe, in the technology, metaverse, etc. universe. So probably it's not going to be about Bitcoin making the dollar disappear or the euro disappear. I don't see that anytime soon, certainly. But Bitcoin being an option in the decentralization of money. And this comes back to a book that is behind me, very small book by Hayek, that was written way before the internet existed, which was Choice in Currency. Is that why do we have to have only one currency? You could have multiple different currencies that allow you to purchase goods and services in different spaces, and that's maybe the option that is available in a more near future than a dystopian no fiat currency future, which certainly is not something that I envision anytime soon.
Great points. I like that, coexisting of currencies. We don't have to be so extreme with our view that it's one or the other, but they can all coexist. Thank you for those points. Now, regarding this banking crisis, what are your thoughts? Do you think it can be contained, what the Fed has done? And or do you think there could be contagion? I know we see commercial real estate and the auto lending industries with that Ally Bank as potential next in line to have major issues. Do you think it will be contained, or will it spread like wildfire?
I would like to start by saying that there is no contagion when everybody is part of a symptom, that everybody's got an illness. No? There's no, you cannot expect a contagion when the problem in the banking system is widespread.
Yes.
Already. No? So the reason why I don't like the word contagion is because it starts from the premise that the cause is Silicon Valley Bank or Signature or First Republic.
That's why I didn't use that word.
No, exactly. Perfectly right, by the way. So I think that is it manageable now? Yes, now it is manageable because there have been a number of lessons from the 2008 crisis, like the 2001 crisis, in which central banks know that liquidity is the first thing that they need to make sure it doesn't disappear. So will that stop other banks from going bust? No. But if you allow the system to get those banks that fail to quickly sell their assets to other banks, then what we call a widespread problem would be avoided, because the reason why there's a panic in banks is not because somebody fails and others purchase the assets. Is because somebody fails and nobody purchased the assets. Okay. In the case of Lehman Brothers, it was Nomura and Barclays that bought the Lehman Brothers assets, and perfectly fine. But the problem is when people perceive that those assets are worth nothing, which is very, very dangerous. So I think that in an ordinate level of I would say, how to put it this way, of creative destruction at the end of the day works. So the bankruptcy of a bank should not worry us if the rest of the banking system gets stronger from it. The problem is if the bankruptcy of a bank, it leads to other banks doing exactly the same bad things, no? And that is the perverse incentive of extreme monetary policy, is that the incentive is not to get stronger, but to be crazier. Huh? We got out of the Lehman Brothers Bear Stearns crisis through the same measures that led to the Bear Stearns and Lehman Brothers, Freddie Mac and Fannie Mae mistakes. And it's 2022, and Fannie Mae continues to lend massively to people that cannot afford it. No, so what I think is right now is it is manageable. It certainly is manageable, and it's easy to see the doomsday scenario, but no, it is not true, in my opinion. I think that it's perfectly manageable. Would that mean that the equity of banks is going to start going up and everything's going to be fine? No, but it is manageable. Now, coming back to your earlier point, if central banks now U-turn and start to cut rates and start to increase money supply, etc., it then becomes unmanageable. Because think about the message that you're giving to any regional bank that is looking at the Signature or Silicon Valley case. If you, in a few months, cut rates and increase massively money supply, what you're basically telling those banks is go for broke. Yeah, it's party time. I remember, I think it was the ex-CEO of Enron who said that if quantitative easing had happened in his time, Enron would still exist. Absolutely. So what we need to do is to avoid that something that is manageable now, and it is manageable, becomes unmanageable in a few months' time.
Perfect. Excellent points. Thank you so much. So what the Fed did, backstopping, was not QE. No. But what are its effects on reducing the balance sheet, and will it slow that process?
Yeah. Oh, it has reverted the process. Has completely reversed the process, or reversed. The balance sheet of the Fed has ballooned and almost, and it's unwound about 67%. So about 70% now of the quantitative tightening. So it's almost 30% from from having done nothing. No, but it is not quantitative easing. But whether it's quantitative easing or not is simply a debate about whether it will create multiple expansion and asset price inflation or not, which is a market debate. It's a market debate between traders and market participants on whether the expansion of the balance sheet of the Fed is going to help the S&P 500 rise or high yield bonds go higher. That is not what matters to us. What matters to us is that it is money printing. That's what matters. That's what matters to us, because um, this is not if you even if I started to entertain the idea of believing the neo-Keynesian miracle of money creation, this, it has all the negatives. Okay, this has all the negatives because this zombifies the deposit base of banks, doesn't clean up the balance sheet of those that have been excessive or have managed things in a different way, and it doesn't improve lending. It doesn't move into the real economy, because obviously if you're a bank that is on the verge of bankruptcy and you get this extraordinary lending facility from the Fed, you might get that extraordinary lending facility from the Fed to continue to survive, but not to lend more to families and businesses. Absolutely not. No? So the problem is that you may have a massive increase in the Federal Reserve balance sheet with a drastic slump in money velocity. And then that gets all the negatives of money printing and zero of the alleged positives, if there are any.
Not good. That we know for sure there. Thank you so much for explaining that so well. Now, liquidity risk. That's what we're talking about here. And in 2008, there was credit risk. In your opinion, do you think this liquidity risk now could lead to credit risk as well?
Yeah, it can. Right now, it's not evident because, unlike in 2008, right now, this banking crisis has happened in a period in which families and businesses' demand for credit was already slowing down. So it's not coming up as aggressively as in 2008, when credit demand was rising and suddenly supply stopped. Now, what you have is an environment in which we've had a few months of negative credit impulse, which is much lower demand for credit from families and businesses, yet now, and a short-term liquidity crisis. So that may lead to a credit crunch probably in a few months, but not immediately, because of the lower demand for credit that was already coming from families and businesses.
Wow. Wow. Thank you for that. Interesting to watch in the next few months. So lots happening in 2023, it seems, and the second half of the year could have a lot more in store for us. So we have balance sheet increasing. We have persistently elevated inflation, rising core month over month. I mean, we're still printing over 5s in core and over, I think, 6 this past month, year over year, CPI, and we have very low growth. Do you still think stagflation is a very likely outcome at some point?
Yes, because inflation may come down, and probably quickly, as the economy stalls, but the pace at which inflation comes down, and we must remind everyone that inflation is accumulative, it may be much slower than the pace at which GDP starts to get worse. No? So what you may end up having is the perverse scenario by which inflation, imagine, goes down to 3.5%, but growth goes to 0. So you're still in stagflation, even though inflation has come down. Now, people tend to perceive the stagflation risk as 1% economic growth with 10% inflation because of the example of prior decades.
Yes.
But that is not it. No, you may have a situation in which GDP is actually contracting in real terms and virtually flat in nominal terms, and inflation remains elevated, although lower than in the current moment.
Thank you. Now, when we talk about GDP, mass government spending is a big contribution holding up that GDP, correct?
This is one of the big and interesting parts of the moment that we're living in. Because if you think about it, in previous inflationary bursts, families reduced their spending, businesses were more prudent about investment, and governments reduced their spending. Yet, this is probably one of the very few examples in the economy in recent decades in which governments are not just not reducing spending, but actually massively increasing it. So the reduction of inflation, the decrease in the quantity of money in the system, is likely to come only from the private sector, which means that if governments are massively increasing spending and the private sector is the one that reduces aggregate demand, that is probably a very severe contraction of the manufacturing and services sector, despite government spending being elevated. So you may find the perverse situation by which GDP actually is relatively acceptable because government spending is very high through higher debt, imports are very low, so the contribution of the external sector to GDP is positive even if exports are not rising, and the private sector contribution is, investment and families consumption is even in negative territory. So you could have a private recession with inflated GDP, and that is extremely dangerous long term, and actually an even bigger driver of subsequent stagflation.
Excellent points. Thank you so much for mentioning all that. And it's so important for people to understand that very important part there. Now, when you talk about the private sector, I think last time we also discussed the earnings recession, and it seems imminent. Would you say so?
Well, I think it's pretty obvious. Now, what happens with earnings is what we market participants understand very well, which is the massaging of consensus. Now, at the beginning of every year, everyone that follows markets like yourself will see, oh, we expect S&P 500 earnings to rise in 2023 by 10%. By January, it's 9%. By February, it's 8%. No? By December, it gets
keep revising.
Exactly. It gets close to zero. Interestingly enough, in that period, because you are downgrading and at the same time companies are publishing, you get the interesting thing that you get a very high level of earnings positive surprise. Why? Because I downgrade my earnings estimates by 5. The company gives -4, which is better than -5. Then it's positive earnings surprise by the market. Okay, well, that is well-known way of managing expectations in the market, and it happens every year. But I think that this time we have on top of that the very negative effect of margin compression in most sectors. And if you remember last year earnings were relatively acceptable because there was a massive boom of energy stocks earnings. But if you deducted the energy stocks earnings growth was already extremely poor in 2022. So the risk of earnings recession is very, very high. And actually, it's a very direct way of seeing what I mentioned before, which is that you may be in a private sector recession in which GDP, that is always overestimating the net economic growth, um, is not that bad, no? So you may have a GDP that is not that bad with earnings that are much worse than probably initially estimated, and coming from the evidence of much worse consumption from citizens and much worse investment.
Absolutely. Margins are compressed and, I don't think it's going to get better. I think it'll actually get much worse with deteriorating economic conditions and financial conditions. And yes, I always love the way you present the economic material and you discuss it. I don't know if you double as an entertainer as well, but you're very funny and comedic and very entertaining. But it's absolutely right. They revise lower and they just continue to do so. And then it's like you said before earlier, it's like human nature. It's a recency bias. So, it's like a slippery slope. It just continues. So we're in June and they've lowered it now to, let's say, 4% from the original 10% in January, but it doesn't seem so much because just last month it was 5%. But they don't think of it in January. So excellent examples. And that's why I love watching you on your YouTube channel. You present the real truth in economics in a very entertaining manner. So I love that. Thank you.
Thank you.
You're welcome. Daniel, I'd like to ask your opinion. What could you tell people? What's a good way to prepare for the future this year into next? I know last time we spoke, one of our clips got very popular on YouTube, remaining liquid. And I think that is an important point. Anything else you'd add to that? If you could just elaborate on that, please.
Remain liquid because the opportunities to invest are going to be there, but it would be extremely imprudent to believe that the current valuations are the bottom. Okay, so I think that is so. In order to look for opportunities, you need to have money to invest in those opportunities. No, the worst thing that can happen is to catch you completely invested. The other thing that I would say is try not to bet against your own analysis of the economy. It's very, very surprising to see. Okay, you don't have to listen or to believe or to follow what I say or what you say or what other economists say. But one thing that always leads retail investors and professional investors to make domino effect mistakes is to take positions on something that is the opposite of the way that they actually see the economy. So if you see the economy as we're discussing, weak growth, weak level of productivity growth, challenging system in the financial sector, very elevated levels of debt, risk of stagflation, and all of this, certainly don't go then and purchase assets in the most cyclical, the most exposed to margin expansion sectors, etc. I think that is that I have this situation all the time with people that meet me on the street and recognize me, that say, what you say about the economy is right, but you are too optimistic. It's much worse than what you say. What you say is it's going to be a lot worse. And then after telling me that it's all going to be a disaster, they tell me, is it the time to buy banks? Well, obviously, if you believe that and you buy banks and there's a correction, you are never going to react in a way that allows you to generate wealth in the future. No? So I always say, invest the closest to what your personal view about the economy is. because then you at least you know when you are right and when you're wrong. If I say I'm going to invest on the case of stagnation of the economy, and the economy actually gets better, then I know that I made a bad analysis and that I can correct. It's perfectly fine. The only way in which people come to the conclusion that the market is wrong and that they don't know what to do is when people invest against what they actually believe about the economy. So my recommendation is do what you think, not what others tell you to do.
Perfectly said. I love that. And I actually say similar things myself. It's very important to be accountable.
Yeah.
And very important. Thank you so much, Daniel, for taking the time to speak with me today. I love all that you do, and you are one of my favorite economists. Appreciate how you spread awareness and truth about economics and how you defend freedom. And make sure everyone, just want to tell everyone to check out Daniel's YouTube channel. It is so entertaining and informative. So thank you so much.
Thank you so much. It's always a pleasure and always great to have a discussion like this, because it's also the topics that are a little bit different from what we usually get in the day-to-day discussion. Thank you so much for your work as well.
Thank you so much. Appreciate it. Have a great day.
Have a good day.